Hello traders, welcome to another episode of Smart Keys FX. Most traders fail, not because they don't have a profitable strategy, but because they try to predict the market's next move, or force a trade setup due to impatience. You see, lack of a rule-based strategy will lead to gambling, which is a recipe to massive losses. In this episode, I am going to break down one of the most powerful smart money concept strategies, that is built around large banks' footprints. What makes this strategy powerful? This strategy combines liquidity grab, the fuel that drives the price, fair value gaps, which acts as magnets to rebalance the price, and order blocks, which is a zone where institutions enter the market. I will explain in detail, step by step, on how to master and apply this strategy. By the end of this episode, you will have a clearly defined rules on how to apply this strategy immediately in your own trading. We always appreciate your support. So please subscribe to our channel and give this video a thumbs up if you are new. Let's look at a bullish scenario. We must first identify the bank's market sentiment in the higher time frame. This forms the foundation of our overall market direction. You can see the expansion legs in this market are stronger with huge bullish candles. This is the first signature of the bank's presence in this market. We can also see the choppiness in this bearish retracement leg showing weak sellers. Looking at this price range, price reversed after this sharp buy-off, but failed to break this low and bounced back. This created this relative equal lows. This is a liquidity pool. Price then deeps down below this level, triggering the stop losses and sell stops resting here. As you know, the banks have lots of positions which may not be executed at once. When they manipulate the price below this level, they seek the most discounted price level. Price then sharply moves in the opposite direction and breaks this structure level. This opens doors for the market to even move higher. We now have this price range to trade within. This level is a protected low, while this high is our next external liquidity level. Price is expected to break it in the next expansion leg. Price has met the following conditions of our model. First, the expansion legs are stronger than retracement legs. 2. Price has swept liquidity, which led to the break of this structure. 3. There is fair value gap created. We then mark this down last candle as our order block. Now, what is the secret behind these powerful banks model? You see, the banks have lots of position to execute in the market. If they offload all the orders at once, the market may crash. So, what do? They often push the price near the key areas to engineer liquidity. They then generate enough volume to execute their orders. These zones are where smart money steps into the market. These manipulation areas form powerful trading zones. Price tends to react to them in the higher timeframe direction. So why does the price react? The pending unexecuted orders act as a magnet that attracts the price back to these zones. As the price retraces back, the pending orders get filled, and this pushes price to higher or lower levels, depending on your setup. For this setup to be effective, you need multi-timeframe analysis. Identify market direction and key areas to be swept in the higher timeframe. Once price has swept liquidity, zoom into lower timeframe for trade execution. If your higher timeframe is 30 minutes, your entry timeframe should be 5 minutes. If your higher timeframe is 15 minutes, your entry timeframe should be 1 minute. Now that we have laid down the rules of this model, let's look at our initial bullish scenario. Price has met all our higher time frame conditions. We anticipate that price will retrace back to this level. Then we look for trade opportunities. We can enter the market using the aggressive approach or conservative approach. Let's start with the aggressive approach. When price taps into our higher time frame order block, which we can see here, we wait for a reaction and take the trade long. The reaction could be a market structure shift, a bullish engulfing candle, or a hammer candle. Once that happen, we take our long position. We target the next external buy-side liquidity level and place our stop loss below the order block. Now, price has tapped into this order block. A bullish engulfing candle has been formed here. This shows buyers stepping back into the market. We enter long here and target this external market structure. We then let the market do its thing since our capital is protected with the stop loss. Risk only what you are willing to lose. As you can see, the market plays according to our analysis. As a smart trader, patience is key. The market will always have internal retracements. This should not scare you to close your position. You can step aside and check your trade after some times. The market finally hits our take profit as anticipated. For conservative entry model, we wait for market structure shift, which we can see here. We then mark this candle as our lower time frame order block. We then enter our buy position at the midpoint of this candle and target the next buy side liquidity. This entry model is the safest, but the downside is that you can miss some moves. Price may not retest this order block. Let's shift to a bearish real chart example. Here, we have Euro USD chart. We can see these aggressive bearish expansion legs. This is the first sign of the banks offloading their orders in this market. We can also see this slow choppy retracement lead showing low buying momentum. Moving forward, we can also see a sweep of this structure high. Price then sharply turns back into the range showing liquidity grab. Looking at the market closely, price broke this structure low after the sweep of liquidity. This opened doors for more bearish momentum. Price has formed a story which we now follow as smart traders. We mark the origin of this expansion leg which broke structure after sweeping liquidity as our fresh unmitigated supply zone. These zones often attract the market. They form high probability trading zones since the banks will often defend their positions or even execute pending short orders. We then mark this up-close candle as our order block. If price pulls back to this level, we take a sell position after confirmation. Playing the market forward, we can see price has reacted to this order block. This gives us an opportunity to zoom into the lower time frame for trade confirmations. Here in the lower time frame, price reacted to this higher time frame order block and broke this structure low, a sign of the willingness of the price to expand even lower. This shows fading bullish momentum and sellers stepping into the market. We can also see this beautiful inversion fair value gap. This also adds confluence to our setup as price always respect them. Now that all our conditions are met, we place our sell limit at the midpoint of this fair value gap. We then target the next sell side liquidity level. As you can see, price tags us in and moves in our direction as anticipated. Price then hits our take profit showing how powerful this Banks model is. Let's move on to another bullish real chart example. Here, we have Euro NZD. We can see that price broke this recent high after sweeping this low. This is considered a liquidity grab by looking at price momentum immediately after sweeping this low. This massive bullish engulfing candlestick show the signature of the large institutions and big banks. Now that our preliminary conditions are met, we zoom into the lower time frame for trade setup and entry confirmations. We can also add other confluences in this higher time frame before going to the lower time frame. When you look at this market keenly, you can see that every low is higher than the preceding low. Every high is also higher than the previous high. This is a characteristic of a bullish market. Looking for buys is therefore the safest option. Focusing on the lower time frame, we can refine this zone to this fresh unmitigated order block. The order block also has a fair value gap which has also not been retested. When price pulls back to this level, any bullish shift in market structure will confirm our setup for buy. Pushing the price forward, price taps this order block and sharply reacts by breaking this structure level. This is a market structure shift showing buyers stepping back into the market. We can place our buy limit at the middle of this candle and target this level as our first take profit. Our stop loss goes below this order block. As we play the market forward, price then triggers our buy order and takes off hitting our first target. At this point, You can manage your trade by taking partial profit and holding some positions to the next buy-side liquidity. That is all, traders, for this video. Thanks for watching. I hope you found value in this video. Please subscribe and hit the notification bell so you never miss any update. Drop a comment for your thoughts and suggestions for future topics. Your support means a lot to us. See you in the next video.